China's refining sector is at a crossroads, and PetroChina's bold move to retire 19 inefficient units is a stark reminder of the challenges plaguing the industry. But here's where it gets controversial. Is this a necessary step towards sustainability or a desperate attempt to salvage profits in a struggling market? Let's dive in. PetroChina, the nation's second-largest refiner, has announced plans to phase out 19 aging and underperforming refining and chemical units. This decision comes as China grapples with overcapacity, which has long burdened the downstream sector. Among these, one unit will be permanently shut down due to persistent safety concerns, while the remaining 18, each with over 2 decades of operation, will be gradually retired. This move, revealed during PetroChina's Q3 earnings call, underscores the company's efforts to streamline operations and align with broader national goals to curb excess production. But why now? China's refiners and petrochemical producers have been caught in a perfect storm of low margins, overcapacity, and declining demand for road transportation fuels. The glut in production has not only squeezed profits, but also overwhelmed the Asian market. Chinese authorities have intensified efforts to address this overcapacity, which has led to refining losses and razor-thin margins in the petrochemical sector. For instance, PetroChina's Q3 earnings report highlights a 4.8% drop in gasoline production year-on-year, while diesel output remains stagnant. The only bright spot? Jet fuel production soared by 9.5%, driven by rising demand in air travel. PetroChina is positioning itself for the future, aiming to advance its transition toward the mid to high end of the refining chemicals new materials value chain. However, this transition isn't without its hurdles. The refining and chemicals industry has fallen victim to the phenomenon of involution, a term describing the self-defeating competition among Chinese companies for limited resources and opportunities. This relentless competition, coupled with price wars, has made oil refiners and steel makers the worst performers in terms of earnings among industrial companies, according to Bloomberg data. And this is the part most people miss. China's promise to tackle overproduction isn't just about saving its refining and steel industries. It's about reshaping the entire economic landscape. But will these measures be enough? As PetroChina takes this drastic step, it raises questions about the future of China's energy sector. Is retiring inefficient units a sustainable solution, or merely a band-aid on a deeper systemic issue? What role should government policies play in balancing production and demand? And how will this impact global markets, especially as Asia remains a key consumer of petrochemicals? As the industry watches closely, one thing is clear. PetroChina's move is just the tip of the iceberg. The real challenge lies in addressing the root causes of overcapacity and fostering innovation to stay competitive in a rapidly evolving market. What's your take? Do you think PetroChina's strategy will pay off, or is the industry in for a rougher ride ahead? Share your thoughts in the comments below.